The Federal Reserve has been cutting interest rates. Mortgage rates have not come down. For most of the past 40 years, those two things moved together. The Fed cut, borrowing got cheaper, and anyone waiting to refinance finally got their moment. That relationship has broken. Millions of Americans have spent months watching rate cut headlines on the evening news and then looking at a mortgage quote that has not moved a single basis point. The reason is not in Washington. It is in Tokyo. Because there is a piece of this that almost no coverage explains properly. The Federal Reserve does not set your mortgage rate. It never has. It sets one specific overnight rate that banks charge each other for lending reserves. And that rate has surprisingly little to do with what a 30-year mortgage costs. The number that actually drives your mortgage is set somewhere else entirely, by people who have never heard of you, in a market most Americans have never thought about for a single minute of their lives. And the largest single participant in that market has started walking away. Japan is the largest foreign owner of United States government debt on Earth. Not China. Japan. Japanese holdings of American treasuries sit at roughly $1.2 trillion. For scale, the United Kingdom holds around $897 billion. Mainland China, the country most Americans assume sits at the top of this list, holds roughly $693 billion. Japan is not just first. Japan is first by a margin larger than most countries hold in total. And in the first quarter of 2026, Japanese investors sold roughly 4.67 trillion yen of American government, agency, and municipal debt. That is about $29.6 billion. The largest quarterly reduction Japan has made in close to 4 years. Now, on its own, that number is smaller than it sounds. $29.6 billion against a $1.2 trillion position is about 2.5%. If you owned $100,000 of something and sold $2,500 of it, nobody would call that an exit. So why did bond desks pay attention? Because of the shape of it. This was not an even trim spread across 3 months. The selling accelerated as the quarter went on. January was modest, February was heavier, March was heavier still. And that pattern is what professionals actually read. A portfolio being routinely rebalanced looks like a flat line. A decision being acted on looks like a curve that steepens. This looked like the second one. Which brings us to the question that actually matters, and it is not how much they sold. It is why now. Japan has been buying American debt reliably and enormously for decades. Through recessions, through banking crises, through American political chaos of every available description. Why would that change inside a single quarter? The answer has almost nothing to do with America. To understand it, you have to understand what Japanese institutions have been living with for 25 years. The Bank of Japan held interest rates at or near zero for an extraordinarily long time. At points it pushed them below zero, which means a lender paid for the privilege of lending money out. Now think about what that does to a Japanese pension fund, or to a life insurance company in Tokyo that has promised to pay policyholders for the next 40 years and has to earn something in order to do it. Their natural home is Japanese government bonds, safe, familiar, denominated in the same currency as the promises they have made. Except those bonds paid effectively nothing. For years, a Japanese 10-year government bond yielded less than half of 1%. You cannot fund a pension on that, so they went abroad. And the obvious destination was American treasuries, safe, enormously liquid, and paying a real yield. Not because those institutions had any particular feeling about America, because there was nowhere else to go. But going abroad carried a cost, and this is the part that gets left out of almost every version of this story. A Japanese insurer buying an American bond is not simply buying a bond, it is taking on currency risk. The bond pays in dollars, its obligations are in yen. If the dollar weakens against the yen between purchase and maturity, the return shrinks, and it can shrink far enough to erase the yield advantage completely. They accepted that risk for exactly one reason. The alternative at home was zero. Now watch what happens when the alternative at home stops being zero. The Bank of Japan has been stepping back from its own bond market. Its monthly purchases of Japanese government debt have fallen from around 5.7 trillion yen in the middle of 2024 to roughly 2.9 trillion by early 2026. Close to half. Here is why that matters. When a central bank buys fewer of its own bonds, there is less artificial demand holding those prices up. Prices fall. And in a bond market, when the price falls, the yield rises. Those are the same event described two ways. Japan's 10-year government bond yield has climbed above 2.6%, the highest since 1997. The 30-year has pushed above 4%. For a country anchored near zero for a generation, that is not an adjustment. That is a different world. And now run that pension fund's arithmetic one more time. They can earn a competitive return at home, in yen, matching the exact currency of their obligations, with no exchange rate risk whatsoever. The entire reason they were ever in American bonds has just evaporated. Now go back to where this started. The Fed cutting while your mortgage rate refuses to move. The Federal Reserve sets the federal funds rate, which is an overnight rate between banks. Mortgages are not overnight loans. A 30-year mortgage is priced off the 10-year Treasury yield because that is the closest thing in the market in terms of duration and risk. And the 10-year Treasury yield is not set by the Federal Reserve. It is set at auction by what buyers around the world are willing to pay for American government debt. So the Fed can cut its rate as often as it likes. If the global bid for 10-year Treasuries is weakening at the same time, that yield stays elevated, and your mortgage quote stays elevated with it. That is not a contradiction, and it is not a conspiracy. They are two different rates, set by two entirely different mechanisms, and only one of them is under American control. The Fed sets the price of overnight money in America. The world sets the price of long-term money in America, and the world has started asking for more of it. Japan is also not acting alone, though the real picture is more complicated than any single headline can carry. The same reporting period showed several other foreign holders reducing their American bond positions. But it also showed net buying from others, including the United Kingdom, Germany, and the Cayman Islands, which in practice functions largely as a routing center for funds domiciled somewhere else entirely. So this is not a coordinated global retreat from American debt. It is a rebalancing, with different countries moving in different directions for different domestic reasons. Anyone telling you the world is dumping the dollar is describing something that is not in the data. And there is a precedent here that puts the whole thing into proportion. In 2013, the Federal Reserve signaled it would begin slowing its own bond buying program. The market reaction was sharp enough to earn a name that is still used today. The taper tantrum. Treasury yields spiked. Investors were caught badly offside. There was a genuine stretch of disorderly trading, and then it settled. Other buyers came in at the higher yields. The market found a new level and carried on functioning. The lesson from 2013 was not that the bond market breaks when a dominant buyer changes its behavior. The lesson was that it moves fast, it overshoots, and then it reprices and works. That is the reasonable base case for what is happening now. So, is this a crisis? No. And I want to be specific about why, because the honest answer is considerably more interesting than either the panic version or the nothing to see here version. This is not a vote of no confidence in America. This is a domestic Japanese story. The Bank of Japan is winding down the most extreme monetary experiment any large economy has run in modern history. Japanese capital is coming home because home finally pays something. That is a story about Tokyo normalizing, not about Washington failing. That distinction matters enormously, and almost every headline on this subject gets it backwards. But here is what I would actually keep an eye on, and it is not the 29 billion. The first thing is the feedback loop, because it is arithmetic rather than opinion. Higher yields mean the American government pays more to borrow. Paying more to borrow means a larger share of the federal budget goes to servicing interest rather than to anything else. A larger share going to interest means wider deficits. Wider deficits mean more bonds have to be issued, and more bonds have to be sold into a market where a large traditional buyer is already stepping back. Each turn of that loop makes the next turn slightly harder. It is not a collapse mechanism, it is a tightening one, and it works slowly enough that it almost never makes the news. The second thing is interpretation risk, which is what professionals actually spend their time worrying about. The mechanics here are benign, but markets do not run on mechanics alone. If other large holders read Japan's move as a signal about America rather than as a story about Japan, they may act on that reading regardless of whether it is correct. Behavior driven by a wrong interpretation moves prices exactly as much as behavior driven by a right one. And the third thing is the one I would watch most closely because it connects to something we have covered on this channel before. When large institutions step back from government bonds, the question is always what they hold instead. And for 3 consecutive years now, the answer from the world's central banks has been consistent and genuinely unusual. They have been buying gold at a pace not seen in half a century, more than 1,000 tons a year. That is not a metals enthusiast's talking point. It is official sector behavior, published quarterly in public. And the logic behind it is not complicated. A treasury bond is a promise from a government. Gold is not a promise from anybody. When institutions begin reducing their exposure to one country's promises, an asset that is nobody's liability starts to look different than it did. Japan is not selling treasuries in order to buy gold. That is not what is happening, and I am not going to pretend it is. But both behaviors are downstream of the same question, which is what a very large institution should hold when the assumptions of the last 30 years stop applying. And there is a practical version of that same question, one that lands on Americans directly. If foreign institutions buy less, somebody domestic has to buy more. American banks, American pension funds, American households buying treasuries directly through the government's own portal, which a lot of people discovered for the first time in the last couple of years. Those buyers exist and they will step in. But they will step in at a price that makes it worth their while, and in a bond market, price means yield. Which means the cost of financing the federal government is quietly being shifted off foreign savers and onto American ones. That is not a catastrophe and it is not a headline. It is a transfer. And it shows up in the rate you are quoted on a mortgage rather than on any government balance sheet you will ever be shown. So, 5 things worth doing with all of this. 1. Stop watching the Federal Reserve for your mortgage rate. Watch the 10-year Treasury yield instead. It is published continuously, it is free, and it is the number your mortgage actually tracks. The Fed's decisions are the headline. The 10-year is the answer. 2. Watch the pace, not the total. 29 billion is a headline. Whether the figure grows again in the next reporting period is the actual information. 1 quarter is a data point. 3 consecutive quarters of acceleration is a trend, and those 2 things mean completely different things. 3. Notice which story you are being told. If a headline says Japan is losing faith in America, that headline has the mechanism backwards. The driver is Japanese domestic policy. Getting that right will keep you steady when the alarming version circulates, and it will circulate. 4. Watch the Bank of Japan rather than the Treasury. If Japanese yields plateau because the Bank of Japan finishes normalizing, the incentive to bring capital home eases on its own, and this stabilizes without anybody doing anything at all. If the Bank of Japan keeps tightening, it does not. 5. Watch official sector gold demand alongside it. It is published quarterly by the World Gold Council, and it takes 2 minutes to read. It is the clearest available signal of what the most informed institutions on Earth think about holding somebody else's currency. For 25 years, Japanese savings had nowhere to go but out. That was never really a strategy. It was the absence of an alternative created by a central bank that held interest rates at 0 for longer than any large economy had ever attempted. That condition has now ended, and the money is doing what money always does when the conditions around it change. The consequence for America is real, and it runs directly into the cost of a mortgage, the cost of a car loan, and the interest the federal government pays on what it already owes. But it is a consequence, not an attack. Nobody in Tokyo made a decision about America. They made a decision about Japan, and America simply sits downstream of it. Which is the part worth sitting with. The largest financial relationship the United States has with any foreign country just changed, and it changed because of something that happened inside somebody else's economy, for reasons that had nothing to do with America at all.